Good day and welcome back to my YouTube channel. This is Gbpchf Institution, the home and art of supply and demand and institutional order flow. So guys, today we'll be going over the trade Gbpchf. So I'll be breaking it down all the way from the higher time frame to the lower time frame, explaining detail by detail how we actually got this trade. So we will be using the alignment method, the same approach we used on CAD-CHF. You can go and check out that video. So it's the very same thing. We just apply the same concept, but then in this video I'll be sharing extra details. Confluence, right? So like you use different methods of analyzing, but then you reach the same conclusion, right? So we're going to be using the alignment method. So the alignment method, you check the current monthly candlestick, the current weekly candlestick, and the previous day. So this analysis was done on Tuesday, so you can only use this method starting from Tuesday, Wednesday, Thursday, and Friday, because the aim of the strategy is to catch the low or the high of the next day, or the current, should I rather say the current day, right? So you can use this methodology on a Monday. You have to wait for Monday to print out the price action, then Tuesday midnight, that's when you can analyze, then put your buy limit or sell limit. So let's get into it. Our monthly candlestick, we can see that it's trading bullish. As you can see, I've ticked current monthly candlestick bullish. Our current week is also trading bullish, right? So we note that down, that our current weekly candlestick is trading bullish also. So when you go to the daily time frame, you want to check the previous day. You don't want to check the current day, you want to check the previous day, right? So our previous daily candlestick, remember this analysis was done on Tuesday, so the previous daily candlestick was also bullish, as you can see, right? It was also bullish. So after we find that our alignment is in order, we have a bullish alignment on Gbpchf, right? So we're going to mark out our equilibrium lines, right? Equilibrium line 1 and equilibrium line 2, right? So EQ1 being the open of the previous day and EQ2 being the open of the current day, right? So yes, let's get into it. Right, so we have EQ1, the open of the previous day, then we're gonna have EQ2 and the open of the current day. So from there, we are going to drop down exactly to the 2-hour time frame. So when you're going to look for your demand zone, since your alignment is bullish, you start checking from the 2-hour time frame, going downwards to look for a fresh demand that price has created, right? So let's do just that. So now, as you can see on the 2-hour time frame, there isn't much between EQ1 and EQ2. And if you know the laws of location, right? If you know the laws of location, you know why I'm saying you must look for a rally base, a rally structure, right? So between the body of either the monthly, weekly, and daily, but I would say preferably daily, right? Preferably daily. That's where you can find continuation structures. The rally base rally for a bullish scenario and a drop base drop for a bearish scenario, right? So we're going to look for a rally base rally between EQ1 and EQ2, right? As you can see on the 2-hour time frame, there is nothing. Going down to the 1-hour time frame, let me quickly adjust my text. There's nothing. 45-minute time frame also, there's nothing much to be seen. Up until the 30-minute time frame. And the 30-minute time frame, that's where we get to see our rally base rally, right? So this is our base. So I'm just quickly gonna show you how the rally base rally formation looks like. So it's a push to the upside, a small pause in the market, and then another push to the upside. So that's a rally base rally. So once you see that, you mark out your demand zone, right? I'll explain later in the video. You must mark your proximal line and your distal line. Your proximal line is your entry point line, and your distal line is your stop loss line, right? So here we just simply use a demand zone, a rectangle. So we're just simply gonna use that and highlight 30-minute rally base rally continuation structure. That's how you're gonna name it, right? So with that being said, you can conclude your analysis, but then there are certain things that you need to check before you can conclude your analysis, right? We're going to check our odd enhancer. We have an odd enhancing scoring system, right? To check the validity of the zone, to check is this zone valid? Can I trade from this zone, right? So there are certain reasons, there are certain factors that we need to take into consideration before actually considering this as a complete setup. All right, so I was just dropping down to the 15-minute time frame to verify if that's a proper rally base rally that we have over there, right? So now let's check some extra factors that we can use to strengthen our setup. Meaning, let's look for confluence. Let's look for reasons why we can trade from that demand zone. Why will we be taking buy trades from that specific area, right? So let's dive right into it. So now, number one, the first thing that we need to check is liquidity, right? Remember, the market is being moved by liquidity, right? Price moves from supply to demand, from demand to supply, right? So meaning price is always fetching what? Liquidity, right? So that's what drives the market, liquidity, right? So now I'll just use two basic sources of liquidity, right? We have two great sources of liquidity, which is equal lows and a fair value gap. Some know it as an imbalance. Some know it as whatever candle. I don't recall what they call it, but then it's one thing, right? So here we identified our equal lows. So we found our first source of liquidity, right? The reason why price must clear those lows, clear liquidity, and then push to the upside, right? Another form of liquidity that we saw, it's a fair value gap. Remember, a fair value gap occurs between three candlesticks, right? The high of the first candlestick and the low of the third candlestick. The distance between, it's what we call the fair value gap, right? I hope we understand each other. So for a bearish scenario, it's gonna be the low of the first candlestick and the high of the third candlestick. The distance between, it's what we call the fair value gap or the imbalance. That shows whether buyers or sellers are in control of the market, right? An imbalance shows a massive injection of buy orders or sell orders into the market, right? Remember, trading is a game of buying and selling pressure, right? It's a game of buying pressure and selling pressure. So an imbalance, it's another way to show pressure, whether the buying pressure or the selling pressure, right? So in this case, we see the buying pressure, meaning we have more buy orders being injected into the market compared to sell orders at the specific price level, right? I hope we understand each other. So now let's move to our odd enhancers, right? So odd enhancers is just a simple a checklist to check if the zone that you have, does it meet the minimum requirements of the approach that we're using. Remember, we are using the alignment methodology, right? Which is like the IOF methodology. So when you use the IOF methodology, there are certain statements that you need to tick after you do your analysis. You do your analysis, then after you go and check whether certain descriptions have been met, right? The rules, everything has rules, right? So you want to check if the rules of IOF have been met, right? So let me just quickly note them down and we'll continue from there. Now let's check our first odd enhancer, right? So our first odd enhancer says, is the zone fresh? Yes. What do you mean by the zone is fresh? We mean after price created the demand zone, it has never retested it. Price has never tested that zone, meaning it's fresh, meaning there are unfilled buy orders. I will make a video on filled orders and unfilled orders in the market, right? Then you'll understand how price moves, right? So now, yes, price has created a fresh demand. That's the first thing that we need to check, right? So on our checklist, is the zone fresh? Yes, we tick it, right? So now we're going to check the time taken to create the zone. So the two main factors of supply and demand is brief consolidation and momentum shift, right? Brief consolidation and momentum shift. Brief consolidation, I simply refer to the order matching process, right? So now there's a certain description for the order matching process. I won't say it due to certain reasons. So, but then in this case, we need to see price take a short time creating the zone, right? We need price to pause for a short amount of time. That's what we consider a brief consolidation. If price pause for a long time, that's no longer a brief consolidation, but it's rather a consolidation. And a consolidation is another form of liquidity. So we don't want that around our zone, right? So the time taken to create the zone is short. As you can see, price did not take that much. It only took 1, 2, 3, 1 hour 30 minutes to create that zone. All right. So now this shows that at this certain area, right? At this certain area, the buy orders and sell orders that have been injected into the market, you can tell that the sell orders have been used up. Hence, we see price going up, meaning buy orders are in control. So price needs to come back and fill what the unfilled buy orders that were left during the order matching process. Remember, the order matching process it's a battle between buy orders and sell orders. But let's save that for later. I'll make a video about it. So right now we are going to move to the profit margin, right? So now when we move to the profit margin, when you talk about the profit margin, we are going to talk about a minimum risk to reward ratio of 1:3, right? So meaning, hence I said we're gonna talk about the distal line and the proximal line later on in the video. So meaning, once price creates the demand zone, a demand zone has a certain number of pips, right, that it uses up on the price chart, right? For example, I just didn't measure the amount of pips, but then I think it will show when I press my long position. But then the distance between your entry point and your stop loss, that's your risk, right? So after price has created the base, once it moves away from the base or the demand zone, it must move 3 times bigger than the amount of pips the zone took. In simple terms, I'm gonna show it. It's regarded as the risk, the total distance between the proximal line and the distance line and the distal line. The total distance or the total amount of pips between the proximal line and the distal line. That's the risk. So once price creates the risk, right, price needs to move away 3 times the risk in order for that zone to be valid. I hope I'm making sense, right? So as you can see, after price created the demand zone, I measured the profit margin, which is 1:3, and the profit margin being what? The first take profit. Once price traces back to your demand zone, the first take profit level is 1:3. Then your second take profit level is the highest point or the lowest point the market made before it retraced back to your zone. I hope I'm making sense, right? So now that I explained the profit margin, so order matching process, like I said, order matching process, it's a battle between buy orders and sell orders in the market. So in order for us to see that buyers are in control, sellers, there won't be too much activity of sellers. Meaning, in this case, we won't see a lot of bearish candlesticks. Do you understand what I'm saying? Around that particular area, right? Going forth also, order matching process, right? Order matching process needs you to understand how the battle between buy orders and sell orders take place, right? But I'll also make a video on order matching process, right? Yeah, order matching process. I'll make a video on order matching process, and I'll also make a video about what about profit margin, right? Is it? Yeah. I'll make a video about all those things. Just keep your heads up. I'll be dropping more lessons and what's not, right? So, and I'll also make a video about location. So now we are saying the zone is located between EQ1 and EQ2, and the zone must be near EQ1, right? I'll also explain why the zone needs to be close to EQ1, right? Yes, and I'll also explain why it needs to be located between EQ1 and EQ2. Why do continuation structures have to be located between EQ1 and EQ2, right? So we'll save those for future, right? So right now let's just do a checklist, and yeah, that is that, right? That is that. So now going forward, what you also need to understand is that price is very fractal, right? Some of my students did miss this trade because of we use different brokers, right? We use different brokers. So I would advise people to always enter 2 to 3 pips before, and also adjust your stop loss 2 to 3 pips below, right? To avoid missing trades or avoid being stopped out, right? Yeah. So now here I was explaining risk is the total distance of pips between the proximal line and the distal line, right? Sorry about that. So price has to move away 3 times the risk in order for the profit margin requirements to be met, right? So if price does create a fresh zone but it does not move away 3 times, then that zone it's not a strong zone. It's not a strong zone, right? So remember, this is an odd enhancing scoring system. Odd enhancing scoring system. So meaning, for example, if we have 5 requirements in order to make sure that your zone is valid enough, you need to score at least 5 out of 5 or 4 out of 5, right? But I would always suggest go for 5 out of 5 setups, so that you know that even if your stop loss gets hit on that specific setup or trade, you would know very well that you did everything that you needed to do. You followed the rules, you followed everything, you followed procedure. So it's just that the trade did not work out, and it's okay, right? And it's okay. So yes, let me just remove the bar replay. I think I pressed it by mistake. So yeah, that is the proximal line and the distal line. I'm just simply gonna remove the FVG line, the fair value gap line, to show you this is the proximal line. Proximal line, which is the entry point line, and we have the distal line, which is the stop loss line. Then the distance between is the risk, right? The distance between is the risk. So now, meaning if the distance here it's let's say 20 pips, meaning our first take profit must be at 60 pips. That's the minimum risk to reward ratio that we go for. under institutional order flow, right? Minimum risk to reward ratio is 1:3, right? So yeah, and that is that from me. I hope I made sense from the start of the video up until now. It's just that institutional order flow has a lot of theory in it, and I can't explain all the theory in one video. So I'll try to make more videos, guys, and so that you'll be able to understand everything that I do here. Because I was just supposed to show you that go to the monthly, go to the weekly, check the previous day, look for a demand zone, take a trade. So, but then I don't want it to be that way. I want people to understand how I came to the conclusion, right? I want people to understand how we came to this conclusion. And yes, that's how we got the trade. I did share the trade in my Telegram group, and the Telegram group is for free, guys. I'll leave the link in the description below for you to join. And yeah, stay blessed, and I hope everything goes well in your trading career. Be patient, be disciplined, stay focused, be consistent, and yeah, that will be all. I'm just gonna show you how much I managed to make from this trade. And yeah, you must plan your trade and trade your plan. Simple as that. So Gbpchf, there we have it. I was able to catch the trade, but then unfortunately others couldn't. This is MLKFX.